Good morning. It is Friday, November 7th, 2025. I'm Zach Howard, and I want to do a ending weekly video here on global macro. A few things, the topics. Looking around the world, we got China, economic data last night. I want to talk about the data centers, the AI, the hype, the bubble, the froth there, and where we end the week in overall markets. A turbulent up and down week with volatility coming back to the show, with liquidity issues continue to be underneath the surface, causing some structural pullbacks here in markets. Let's look at China. Started off with last night's China big rate of change slowdown, looking at a deflationary print here on the exports and the imports stats out of China. We're looking at previous month 8.3% positive on the exports to negative 1.1%. That's a massive rate of change slowdown, deflationary, which speaks to the bond market over here of China. Imports, the same thing, big, massive rate of change slowdown, 7.4 to 1.0%. That's what we're looking at. A quad 4 macro environment, risk off in China, that continues to be in a slowdown structurally. And the bond market in China, which is centrally controlled more than any other bond market, they're all controlled somewhat, but it's a closed capital system in that communist regime. You're looking at the 10-year yield on the Chinese 10-year bond, 1.74%, versus in the US, 4.10% thereabouts. So massive slowdowns continuously. I do have an interesting article I'll post in the comment section though about China's productivity and what they are actually doing, how they're way more efficient than the US, obviously in the manufacturing standpoint. A couple of analysts and investors I follow took a investing tour to Hong Kong, Shanghai, and a bunch of Chinese manufacturing cities in the last week, and they reported back what they're seeing is just unbelievable. And they think that China's going to have, they're coming out of a GFC type moment here in 2026, 2027, looking at the lens of BYD, who are making 1 million EVs a year. Everybody focused on Tesla, but BYD, much stronger product, much bigger sales. Tencent, Alibaba, these Chinese companies, they are the big contrarian play. But for now, they're sucking wind from a macro standpoint. They're not too excited to get in there yet, but maybe in 2026, early in the year, China looks appealing. Back to the US, I talked about the structural issues inside the liquidity component of the Fed and the Treasury in the US this week, how it's really potentially causing volatility here in other markets, particularly crypto, most vulnerable to it. The Treasury General account and the issuance of short-term T-bills, Treasury bills in that market really straining liquidity, the plumbing system, and is causing some concern in market pundits. Particularly last night, you had John Williams, a Fed representative, actually come out and saying out loud, may soon need to resume asset purchases. So they are going to end QT here December 1st. They haven't officially said this is what we're going to do for our buying of mortgage-backed securities, treasuries again, but the market is kind of signaling they're going to have to, they're forcing their hand. And that's what we're seeing in the underlying volatility. One of the most interesting stories I've seen this week, this here CEO of Microsoft coming out and saying, listen, we got plenty of chips. The GPUs sitting in racks that we cannot use, we purchased from NVIDIA. The constraint is the power, the ability to power these chips, keep them cool. That is what they are looking for. And that is the biggest constraint in this AI bubble, beyond to scale it that they can actually get all the production out of it. It's not the NVIDIAs, it's not the chips, it's not the AMDs. It's like, where are you going to power these things? A steady power source. Where I live, we have massive amounts of hydroelectric power, which is environmentally friendly and is steady power. They should be looking to do deals with the Newfoundland Labrador government. The government should be looking to do deals with them as opposed to fighting it out with other governments. Forget that these mega cap tech companies, Microsoft, Google, Amazon, Meta, Oracle, etc., are bigger than most G20 nations on a fiat balance sheet standpoint at this point. Do a deal with them. Which brings me to uranium. Uranium is one of the essential components of this energy build-out that's going to be needed if this AI hype can be 1/4 of what they are projecting. And in the last couple of days here, the US government has updated its critical minerals list, adding uranium to it. Also added to the list was copper and silver and some other minerals not too familiar with, but I continue to think long term, if you really are excited about AI, data centers, all this build out, instead of playing it from the lens of those companies that are focused solely on that, how about focusing on the ones that are going to actually provide the juice to run these things? This is the framework of where they came from, critical minerals list and updating. Like I said, they had a draft version earlier this year, and then just yesterday they rolled it out. It provides a clear data-driven roadmap to reduce their dependence on foreign advisories, particularly in that rare earths critical mineral list, which China has an advantage. And China also has an advantage because they don't have people worrying about plastic straws and green agendas. They are building massive amounts of power through coal plants, through hydroelectric, and they have an upper hand in this AI race because of that. US coming around to it. These are the list of the critical minerals now that have been added. So if you're a developer or you're an explorer, you're in the mining industry, and you have one of these products, the US government is probably looking very fondly upon you, and you are looking fondly upon the US government to try to advance your project. Lead, phosphate, silicone, copper, silver, potash, boron, etc. That's what we're looking at. Why matters? Why does this matter? Like I said, it's going to help individuals that are invested in these type of companies, these projects, and the companies themselves have more of a fast track to getting into production than they otherwise previously would have. For instance, there's copper projects in Arizona that have been red taped to death, where they're not actually going anywhere for the last 10, 15 years. If they could bring them online, like some of the copper shortages will be not so much dependent on DRC and other places you're not going to take your family on vacation where you develop these mines. It's really a reactive approach to being boxed in by China, some of the supply constraints on these minerals, but they are making moves now to try to get there. Benefits for me, what I'm looking at is uranium, the federal incentives, the expedited permitting, potentially that there's some kind of good, bad, or indifferent partnerships with the U.S. government in terms of a purchasing program for the utilities to guarantee supply, keep these nuclear reactors that provide power online. You can build these billion-dollar nuclear plants, but if you don't have the uranium that's enriched to run them, what does it matter? So, streamline collaboration between DOE, DOI, DOD, Department of Defense, Department of Environment, Department of Investment, etc. That's the takeaways. It will provide energy security, national security, supply resilience, clean power system. If you believe in any of this stuff, you have to believe in uranium, and you have to believe in the ability for power to be sourced through this natural resource that is essential for building out the AI, building out the data centers. Ways to play it: the Global X Uranium ETF, the URE, which has a basket of miners, chemical, sprott physical in there, a couple ones from Kazakhstan I can't even pronounce. You can't get exposure to if you want to buy in the US or the Canadian market. So that is a way. It's something that's been on my radar, and I actually started purchasing a small amount, 100 basis points investment capital here yesterday in this bullish trend pullback, but it's pulled back again here today. So I'm going to just wait and watch for now, because this seems like we could be in for a deflationary spiral in US, similar to China, into December. So I'm cautiously optimistic and just waiting and watching on that one. Another one for super higher beta, super higher risk. If you're really bullish on uranium, this one's been on my radar for over a year. District Metals, Canadian company, OG in the mining sector as an investor in Canada. Warren Orwin, I think his name is. He put me onto this last year. 35 cents at the time. Looked at it a little bit of 50, got out. But back on my radar, it has a 1.75 billion pounds estimated resource in Sweden, which has been in a moratorium for uranium for the last few years. That's now being lifted. 1.7 billion pounds. Uranium is now $78 a pound. Do the math. I still got to build the friggin' thing and all that. But super high risk, but potentially long term, one to put on the radar. Now let's look at the other side of the coin of all this. Yeah, we need all this energy to build it out, but how frothy has the market got with some of this stuff around, particularly this company, which I think is really on the shady side to say the least. Sam Altman gives me vibes. I wouldn't leave this guy with my dog, let alone with my kids to look after for a few hours. And here he is running this company that wants to control the world from an AI standpoint, out advertising they're going to hit 20 billion in annualized revenue this year and has potential run rates for the hundreds of billions. What does that matter if you're spending 100 billion to get 20 billion in revenue? You're losing a monster amount on every dollar you get. So it doesn't even matter. Good color down here from this guy talking about, listen, these companies are letting you create a meme, a little 30-second video using your product. Is costing $60. If you had to pay for that $60, no way you do it. So they're eating that cost like a mining company would be eating cost looking for your resource, drilling for the resource, exploring. Is that even going to turn up into shareholder value down the road? Jim Chanos, long-term short seller, critical of some of these frothy companies over years, hasn't been successful from an investing standpoint, but still knows math and accounting and cash flow. And he's out here saying what we're saying. This is basically crony capitalism now, that OpenAI is lobbying to have their debt backstopped by the U.S. government because it's a critical manufacturing resource to kind of keep in the race with China. You've seen this mayor that got elected in New York this week. You see a lot of leftist policies. The reason why you're seeing a lot of this stuff is because this is what we're seeing is not capitalism, crony capitalism, supporting these billion, trillion-dollar companies, Elon Musk type companies, and the average person doesn't understand any of this and say, this does not make sense. That's why you're getting the swing so far to the right, now so far to the left, is certain demographics of the voting public. And I think it only accelerates from here. You get an AOC run, and you get other people really upset as this continues to build out. Where are we in U.S. markets? Like I say, volatility's picked back up. The VIX above 20 here on a Friday. NASDAQ pulling back hard. However, after the day, as I mentioned, there is roughly 80% of the companies in the S&P 500, particularly those big mega cap tech that move the market out of passive flows, can buy back their stock. So that is a potential event catalyst starting next week. Water market continue to go higher. Another potential, this wicked chart here from Tier 1 Alpha, the vol control funds, the systematic funds that don't care anything about earnings or price to book or multiples that we look at from a fundamental standpoint. Every time we've seen this blue line capture down, they came back to buy the market in the last couple of years. This time here, implied volatility gets so low, they come back in and buy. The market goes higher. This time here, back in April, and now potentially here again, bringing the S&P to 7,000 before we end the year. A quick overview of what's in my macro notebook for the week. And I love this photo here from the World Series MVP pitcher, the Japanese pitcher who is in mid-game studying and mapping and trying to instill better processes around his craft to get even better. In between innings, he's studying the game. The game is changing live, and he's adapting to it. And that's what I'm trying to do in my notebook each day. I'm looking for trade patterns. I'm looking bearish and bullish trends, highlighted in red being bearish trends, highlighted in blue being bullish trends. Standouts for me here today, the end of the week, we have the Russell Small Cap IWN. If you want to look at that standpoint, it's gone from bullish to bearish trend and stop making higher lows and higher lows. Is a potential warning sign that December sets up for a big risk off event, along with the VIX spiking. VIX, the volatility S&P, now got from bearish, those red lines over the last couple of weeks, to neutral. Another potential catalyst is the stronger US dollar off right here. Weaker Japanese yen continues to weaken against the dollar. And Bitcoin, the most sensitive asset in my list there, to liquidity, to risk off, continues to show lower lows, lower highs, and really struggling to really kind of stay around 100,000 here is something to be paid attention to, no doubt about it. And the Bitcoin to gold ratio down to 24.9, haven't seen this low in quite some time. These type of risk and these type of pricing in markets that I'm looking at are saying it is time to kind of take some caution here, even though potentially we still go higher. Is a Goldilocks scenario. That's what I got for you this week. We'll see you again next week. Have a good one.